Hello, everyone, and welcome to this brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. We are absolutely thrilled to have you with us today as we tackle what is, frankly, a pretty complex Ind AS 109 issue. We're going to be breaking down the nuts and bolts of debt investments measured at fair value through other comprehensive income, what we commonly call FVTOCI. So if you've ever found yourself totally tangled up in the accounting web of fair value adjustments and impairment losses, you are in exactly the right place. Let's get into it. Now, you might be wondering, what exactly is the core dilemma here? Well, this is the main headache that auditors and finance pros face all the time. Think about it like this. If the fair value of an instrument automatically bakes in credit risk and time risk, how on earth are we supposed to isolate and segregate the impairment provision, which is based on expected credit loss, or ECL, out of that FVTOCI measurement? It kind of sounds like a paradox, right? No way we can pull that off. But don't worry, the accounting framework actually has a really specific, highly logical mechanism for handling this exact thing.
Here's our quick roadmap for today's explainer. We'll start with the FVTOC dilemma, define clean versus adjusted fair value, walk through a practical scenario tracking amortized cost, recognize the expected credit loss, tally up the final balance sheet impact, and then share some really helpful resources with you.
All right, kicking things off with Section 1, Welcome and the FVTOCI Dilemma. Moving right along to Section 2, Clean versus Adjusted Fair Value. These are absolutely crucial distinctions to get right for accurate reporting. Let's nail down some definitions first. When we talk about clean fair value, we're referring to the unadjusted change in fair value that gets recognized entirely in profit or loss. This happens when your asset is classified as fair value through profit or loss, or FVTPL. If your asset is sitting in FVTPL, honestly, life is pretty simple. The whole change in value just flows right into the P&L as a perfectly clean fair value gain or loss. Easy, right? Okay, but let's dive into the comparison here. According to paragraph 4.1.2a of Ind AS 109, FVTOCI is a completely different beast. Unlike FVTPL, where the entire gain just happily goes to the P&L, FVTOCI requires you to essentially maintain two parallel accounting tracks. Why? Because the asset's cash flows are solely payments of principal and interest, and you might end up selling it for reasons other than just credit risk management. So you have to keep track of its amortized cost. The change in fair value that gets recognized in OCI is not clean. It's actually adjusted for interest, using the effective interest method, of course, and for impairment. Both of those adjustments have to hit the profit or loss statement. Let's jump to Section 3, Scenario, Tracking Amortized Cost. Let's put some real numbers to this to see how it works in practice. We're going to use Indian rupees for this example, tracking a standard reporting period from the 1st of April right through to the 31st of March. So let's say on April 1st, your initial measurement of a debt investment is 100 rupees. Fast forward to the 31st of March, and the subsequent fair value has climbed to 150 rupees. Now remember those parallel tracks we just talked about? We also have to track the amortized cost over the year. Assuming there were absolutely no cash inflows, but we did accrue interest on an effective interest basis of 10 rupees, our tracked amortized costs now sits at 110 rupees. So, looking at our first couple of journal entries, for entry 1, we debit debt investments at FVOCI for 100 rupees, and we credit bank for 100 rupees. Boom, that's our initial purchase. Now, entry 2 deals with the effective interest. We debit debt investment at FVOCI for 10 rupees, and we credit interest income for 10 rupees. So the P&L rightly recognizes that 10 rupees of interest income, bringing our debt investment's overall carrying amount on an amortized cost basis to 110 rupees. Now, check out this 40 rupee figure. Where exactly is that coming from? Well, our actual fair value at year end is 150 rupees, right? But our tracked amortized cost is only 110 rupees. The difference between the two, 150 minus 110, is 40 rupees. This 40 rupees is the fair value gain that we absolutely must recognize in other comprehensive income. And honestly, this brilliantly illustrates the mechanics. For journal entry 3, we debit debt investment at FVOCI for 40 rupees, which boosts the asset's balance sheet value right up to the required 150 rupees. Then we credit debt investment OCI for 40 rupees. You see, the OCI is absorbing that fair value adjustment perfectly. It keeps the P&L totally clean of those market fluctuations, while still accurately reflecting the asset's true value on the balance sheet. Which brings us to Section 4, Recognizing Expected Credit Loss. We've handled the fair value gain, but what about the impairment side of things? Let's assume that based on the expected credit loss model, we're looking at an impairment loss of 10 rupees. As a quick reminder, the ECL is the present value of all cash shortfalls, so the difference between the contractual cash flows you are owed and the expected cash flows you actually think you'll receive. This 10 rupee loss definitely needs to be recognized. So the crucial point here is, how do we actually record this without totally messing up that 150 rupee fair value currently sitting on our balance sheet? Look at our fourth journal entry. We debit impairment loss for 10 rupees. Now that hits the profit or loss statement directly, which perfectly fulfills the requirement to recognize credit losses in P&L. But, and here's the kicker, instead of crediting the asset directly, we credit debt investment OCI for 10 rupees. So this loss allowance is recognized in other comprehensive income. It's honestly a highly elegant solution because it cleanly separates the impairment from the overall fair value change. Let's tie it all together in Section 5, Final Balance Sheet Impact.
So here's your final snapshot. On the balance sheet, the asset is correctly stated at 150 rupees, which is its true fair value. Down in the statement of profit and loss, we have 10 rupees recognized as interest income and 10 rupees recognized as an impairment loss. And finally, in other comprehensive income, we are holding the fair value change of 40 rupees right alongside the loss allowance of 10 rupees. Literally, every single Indian rupee is accounted for. Everything balances out flawlessly, honoring both the fair value measurement and the expected credit loss requirements of Ind AS 109.
Finally, Section 6, Resources and Next Steps. You know, the specific issue and response we're unpacking today is drawn straight from the massive issue repository over at gayadvisors.com. That platform currently hosts over 4,500 issues and the responses regarding Indian accounting standards and Indian GAAP. And the best part? Any person can register for completely free. Once you're registered, you can submit your own issues on Ind AS and Indian GAAP, and you'll get a highly detailed response delivered directly to the inbox of your registered email. This is an absolutely crucial resource, particularly for auditors who really need to rigorously document exactly how they addressed any specific issue relating to the application of Ind AS. Also, this topic was actually featured in the 227th edition of the GAAP Advisors Task Weekly newsletter, which is brilliantly authored by C.A. Manish C. Iyer, director at GAAP Advisors, and published over on LinkedIn. To date, 232 editions of this weekly newsletter have been published. If you are registered on LinkedIn, I highly encourage you to subscribe to the newsletter for free so you can get these expert insights on a regular basis. And hey, if you want to do a really deep dive into the issue we've dealt with in this explainer today, you should definitely connect to the GAAP Advisors Ind AS Clinic podcast. You can find these comprehensive audio sessions on Spotify, Amazon, or right here on YouTube. Just search for GAAP Advisors Ind AS Clinic podcast. Just a quick note before we finish up. The views expressed herein are the personal views of the author and are not binding on the audience. We always request that you seek the help of a qualified expert before taking any action or refraining from any action based on the views discussed herein. And that's a wrap for today. Thank you so much for hanging out with us and giving us your time. If you found this breakdown helpful, please drop a like, add your thoughts in the comments on this explainer, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already subscribed. I also want to request that you share this explainer among your contacts, your colleagues, and your audit and finance teams. Let's work together to spread the knowledge of Indian accounting standards far and wide. Keep learning, and I'll see you in the next explainer.